Hey guys, Mike here. So, oh boy, what a bloodbath in the market today. You might have noticed the markets were a little bit, just a tad bit red today. A lot of selling going on. And of course, there's a few things that caused this. One of them is what we talked about yesterday in the video and stuff. And I want you to understand there is, to answer questions here, there's different mindsets, right? Like I hear people, I'll see them in the comments say, oh, you sure are bullish. It's like, no, not bullish. You can be short-term one thing, long-term the other, right? And so, of course, for the far-out future, of course, I'm always am because the market goes up like over 70% of the time at least. But for the next 3 months, overall 3 months, sure, I can absolutely see, a rally in the year end because I'm just betting on greed. The people on Wall Street to get their year-end bonuses and seasonality play out, right? But as I've said multiple times now, and just people who are new, and I just did a members video saying this, if we don't hit a recession first or second quarter of next year in 2024, I'll be stunned. I mean, look, I'll just put my hands up and say, what can you do? I mean, maybe I'm the only one, but show of hands in the comments. Am I the only one that would be shocked by that if we didn't get one? I mean, again, it obviously there's no guarantee in that, but just looking at numbers and data and this, that, and the other, but again, we are in a year of first or a time of first, and we're seeing many of those first. So, we'll have to, see what happens there. But that's just kind of how I stand for those who are wondering and stuff. Again, not financial advice, just my personal opinion. Now, let's go into what happened, and then we'll go into some really, really critical things here. You don't want to miss this, really critical things. And what happened right out of the gates this morning, which we should have known coming, was, as I told the members, the U.S. dollar surges to over 107, right? New 52-week high right out of the gates. You got treasuries. They start taking off. It just killing stuff. And, of course, I'm not the only one thinking this. I finally found a source came out today. According to Apollo, I told you guys, China, Japan, all these guys, if they keep selling bonds or start selling even more of them, it's going to drive yields up. Well, they say, well, China has sold $300 billion since 2021, including $40 billion since April of 2023 this year. And we think Japan's doing the same thing, which of course does what? It floods the market with treasuries and bonds, right? Which drives the supply up. What happens to the price of the bonds and stuff? They go down. What happens to yields? They go up. Okay. What happens to stocks? They go down. That's usually what happens. Now, the other thing is, and I'm just going to put this one 10-second clip in here of like a 6-minute interview with this guy. And I don't want to put these in here from MSNBC or whoever this is, but this guy comes out yesterday, and I thought it was a kind of a gimmick at first, but then he started talking. I was listening to it, and it freaked people out because this guy has been around a long time and everything in the bond market. But listen to the main line that I think really freaked people out.
We have a lot of potential room to run to the upside. So if somebody asked me and held a gun to my head and said, listen, the worst case scenario, where Treasury rate's going to go 10-year, I'd say in the next 7 years, you should be able to see 13.5%, 14%. Yes.
And don't you love the lady's reaction? Are you serious? What? And notice he said, though, people missed the part where he said 7 years. And his whole, you can listen to the whole thing, it's like 7 minutes. But his whole analysis is the Fed, as we know, I explained it many times, manipulated the market for so long trying to hold down yields and stuff because they were the biggest buyer of bonds from 2010 on. It's like holding a beach ball underwater, right? What happens when it slips out? It skyrockets up. And that's why you're seeing these big moves up. There's just so many things on top of it that affect the yields. The other thing is what's going on in Washington, right? What they keep doing, kicking the can down the road, increasing the debt at a rapid pace, increasing the deficit at a rapid pace, and putting it at risk for another downgrade. As your debt gets higher, whether this is on personal, business, or government level, and your deficits increase, right? And what happens? You become more risky. So to get people to actually take on your debt, what do you got to do? Got to give them a little something more, a little taste here. Here you go. And so yields keep going up. So, and again, there's so many other things that can affect it. So eventually, people keep calling for a top. You would eventually think we would top out on the dollar and the yields at some point in time. Put in the comments what you think that's going to be. Now, the other thing happened 30 minutes after open. Told you watch out for this one. JOLTS job report comes in way hotter than expected, right? 9.61 million versus 8.82 million. So when that happened, man, I mean, things just went down fast after that. And one thing I told you about yesterday was Japan intervening. And you can see this is what I was talking about with the dollar spiking, right? So it spikes up. But then what happens, it hits a certain level. It was either the JOLTS job report or Japan coming in on this one because you see the huge spike down coming in a little after 10 and stuff. And so they could have started to intervene because this is the same level the yen hit last time with this when they started to intervene. So let's keep an eye on that. Again, if you have a source where you can track what Japan's doing when it comes to this kind of intervention. And guys, before we continue, please hit that like button. It helps people find the video. I really appreciate that. And if you like this kind of content, think about hitting that subscribe button down at the bottom. Please let me know and everything. Now, one thing I want you to get out of your minds too, by the way, I hear this a lot, and it's not true. Is I hear people say, well, you know, there's a presidential election coming up. There's no way they let the stock market crash. Folks, this is a pre-election year. Okay, in pre-election years, you usually get run-ups. But think about this. In the 21st century, when did the 3 largest crashes we've ever seen in our lifetime happen? The dot-com was in 2000. Bush was put in office in 2000. 2008 financial crisis. 2008, right? That was when Obama was put in office, okay? 2020. That was an election year. That's when Biden was coming into office, right? Or getting elected, excuse me. 3 biggest crashes, all during the election year where we're actually going to the ballot box, okay? So keep that in mind. It can absolutely happen, okay? And it just will happen to coincide with recessions happen too, right? But also understand this about October. I told you guys October is iffy, and I said the first week especially, and understand why. It is the most volatile month of the year. October has been the month showing the largest percent changes, both in Black Monday, 1987, and 1929, as well as 3 of the 10 largest moves since 1987. Where do we bottom at? Last year, October, right? And if you look at this, these charts pretty much show you what I'm talking about. S&P 500 index, monthly change, right? Absolute value. Who's number 1? It's October. So September is the worst month of the year for stocks. October is the most volatile. This is something you can use for the rest of your life, okay? Make a note of this. Never forget that. We go on to the next chart. What do you see? S&P 500 index, monthly change, annual from 1987 to 2016. What do you see? It's October, right? It's not even close. And so why is that important? Because simply it lets us know one of 3 things, right? 1, buckle up for volatility. Watch the VIX, right? Might be spiking here for a reason. 2, we're either going to get a nice sell-off and major crash in October, pick up in December, November, December, or we're going to end up getting the rest of the sell-off, and this is what I'm about to ask you real quick here. You make your mind up for yourself. And finally, respect one of these 200 moving averages I'm about to show you, and then go for a nice move up into the rest of November and December and have a great end of the year, right, before we have to deal with 2024. All right, now, you choose on this. Which 200 moving average is going to get respected? Here's the S&P 500 index. There's the 200 moving average. We're very close to it. You see it lining up right here, right below that is a major level I told you about. It breaks this. People better grab some parachutes, okay? So just keep that in mind as we talked about the other day. Now, is it going to respect that one? Or come over here to the NASDAQ 100. Look how far down because of those Magnificent 7 this is. Another 6.5% to hit that 200 moving average. And that will absolutely put us down there through that weekly fair value gap, which I actually would vote for that one because I think it would set up the year end a lot better. But again, maybe not. So again, if you look though, this right here is pretty big support level right there, right? For it to break. And I'm probably going to move this down just a tad bit there. So instead of an alert. So this right here would be, you know, a really big support level to break. If it breaks that, I'm like, okay, I guess we know which one we're going to be respecting. And it ain't going to be the S&P 500 200 moving average. The other one to look at, the NASDAQ Composite Index has a lot of stocks, okay? Only about 3.7% away from this 200 moving average, sitting there with that nice key support level, which I've already lined out for you guys. You can write that one down. This is where we don't want to go below. And before you make your decision in the comments, I'm going to add one more thing in here on the S&P 500 chart. That is the year-to-date anchored VWAP. So you got nice little bit of confluence here. You got your 200 moving average, year-to-date anchored VWAP, plus that nice support level. There's those 3 things going on right there. So put in the comments, which 200 do you think the market's going to respect? Obviously, if it respects the NASDAQ, we're going much lower in the S&P. Now, moving over to the stock that just keeps on shocking me, and I was telling members I don't understand why, is Apple. It was down like 1% today. That's it. Like, they just won't let this stock fall. Not like the rest of them. Look at this thing. I mean, if they would just let it fall down through that gap, hit a nice support, hit the 200, moving up. That'd be a great capitulation moment. I'm right capping here. It stands for capitulation. But again, it's treated different than any other stock. If today does not show you that, I don't know what else will, because the other stocks were way down compared to this one, even the big ones. Now, Tesla held up rather well too, right? What held it up? That 100 moving average came in handy, okay? It didn't, you would think it'd be down way farther, but it was not. Again, they don't want to go down here. This is where bulls don't want to go. You know, Tesla has a great following. They fall down there. We might end up breaking that trend line, filling those gaps, because the 200 is quite a ways down as well. Now, for semiconductors, SMH, I showed you this a while back. Shared it with members. It's fallen out of that rising channel. It was in this wedge, which it actually broke out of, got rejected off that rising trend line. And so let's watch this one carefully, because what is it made up of? Mostly NVDA and Taiwan Semiconductors. Speaking of semiconductors, AMD, big red day today. What saved it? It's year-to-date anchor VWAP once again. Rise to the rescue. The 200 is right below this right here. We could see it start heading down around 95, 96 before you hit support, which would be the bottom of that channel, and a 200 moving average. But we'll have to see, you know, because this was a big sell-off today. See if we get some kind of bounce or it continues going down. It's amazing it's been in that downward falling wedge this long. Palantir, I'm putting these in here because you guys requested them. This one right here, I wouldn't worry about Palantir until you get past $13.70. If that happens, absolutely, the thing will plummet. But look at this, 1, 2, 3, 4 times the dip buyers have come in. It has a big time following. You pull up the moving averages, obviously broke the 100 today, but there's that 200 sitting around 1170. That would be your first hope for support right there. That doesn't happen, around $9.30, so sub 10. So far, another one requested. This right here is falling right back in that channel, or the block of support it's been in since like April of last year. Again, it's heading down towards this 200 moving average, which it needs to hold around $7.30, it looks like right there. If it breaks that, we're heading down to around 650, I believe. You can see right here, no momentum whatsoever for this one. RSI looks terrible, MACD looks terrible. And when you get your big moves, when that MACD crosses that zero line, you get big moves in stocks like this, okay? And it's got a little ways to go. And then here's PayPal, another one that gets requested a lot. You can see right here, still in that falling wedge, which has been in forever and a day, below all the moving averages. And when you look at it, again, look at the MACD, look at the RSI on the daily. It just looks like a hot mess. Now, one thing to keep in mind, we're at a key level. Once again, it's falling back down. Why is this a key level? We're going all the way back to 2017. This is consolidation. That means you get some support. If it breaks that, here's your next form of consolidation. So it'll fall down between 53 and 55. It cannot hold, and this sell-off continues. If that doesn't hold, maybe you're lucky enough to hold 50. All right, so it's kind of where you're looking right now. Now, when it comes to economic data, this is stuff that will shift the markets in the morning. ADP employment change, S&P 5 global composite PMI, S&P 5 global services PMI. This is important stuff. That's 15 minutes after the bell opens. The ADP is 8:15. Then usually it's a conflict with the jolts. They tend to go in opposite directions. 10 o'clock, then you're going to get factory orders coming in month over month and a bunch of ISM services data. There's bombshells being laid out here tomorrow, okay, folks? Then you're going to get a bunch of oil stuff. At that point in time, I don't think people are going to care about that, to be totally honest with you, because the other data should absolutely trump that. And there will be another Fed speaker coming out, and so they've been coming out in droves, either saying another rate hike might be necessary or we're going to hold for longer. Okay, so I don't know if this person's hawkish or not. We'll have to see on that. But again, a lot of data coming out. So what's the mantra for this month? Volatile week. So if you're a trader, you're going to love it. If you're a long-term investor, it's very simple. As we saw in the Discord. Have your list of stocks. Have the price targets where you want to buy at. What does that mean? Price targets where you're not going to lose 1 wink of sleep if the stock you pick, or the stocks you pick, continue to go down, and you just have one level after the other where you're going into it. That's how I feel about it. Again, do your own thing, not financial advice. So, and just look at it this way if you're a long-term investor. You're getting discounts. Might get a bigger discount next year, but you're getting discounts, and nobody knows what the hell is going to happen next year, okay? So just keep that in mind. So anyway, let me know what you guys think in the comments and stuff. Appreciate all you guys watching. Hit that like and subscribe button for me, guys. You're the best, and I'll see you tomorrow for another volatile day.